Hey, welcome. Today, we are going to break down the stock market and make it super, super simple. We're going to show you exactly how to start investing, even if you think you don't have enough money to do it. So let's jump right in. All right, let me ask you something. When you hear the word investing, what's the dollar amount that pops into your head? For a lot of us, it's this huge, kind of scary number, right? But what if I told you that whole idea is, well, it's just wrong? $100. That's it. Seriously. The very same system that millionaires use to grow their wealth, it's available to you right now for an amount you might spend on a nice dinner out. So here's our game plan. First, we'll pull back the curtain and demystify the stock market. Then I'll give you a super simple three-step plan to get going. After that, we'll talk about how to think like a pro. And finally, we'll cover how your journey can start, like today. Okay, first things first, let's tackle what the stock market actually is. I promise it's nowhere near as complicated as it sounds. And just getting this core idea will make you feel way more confident. At its heart, the stock market is just a marketplace where you can buy tiny little pieces of big companies. These pieces are called shares. So when you buy a share, you literally become a part owner. And here's the cool part. When that company does well and grows, your little piece of it becomes more valuable. Your investment grows right along with it. And this brings us to a really important mindset shift. Investing is not gambling. Gambling is a short-term, high-risk bet. Investing is about ownership. It's a long-term strategy where you're building wealth by owning a piece of successful, growing businesses. That difference is everything. Okay, you might be thinking, great, I get it, ownership, long-term, but there are thousands of companies out there. Where on earth do I even begin? That's the million-dollar question, right? Well, luckily for us, there's a really simple, powerful answer. Meet the S&P 500. See, instead of trying to find that one needle in a haystack, that single winning stock, which is almost impossible, you can just buy into a single fund that holds a tiny piece of all 500 of the biggest companies in the US. We're talking Apple, Microsoft, Amazon, the whole shebang, all in one go. This gives you what we call instant diversification. So why is this so popular? Just look at the history. Over the long run, the S&P 500 has historically returned an average of about 8 to 10% per year. Now, of course, past performance never guarantees future results, but it shows you the incredible power of just owning the broad market and letting time do its thing. So we know the what and the where. Now for the fun part, the how. This next section is your simple, actionable plan to go from just thinking about investing to actually doing it. Here it is, your 3-step launch sequence. It's really this easy. Step 1, you open a brokerage account. Think of it like a special bank account just for your investments. Step 2, you put your money into a simple S&P 500 index fund, just like we talked about. And step 3, you adopt a long-term mindset. That's the playbook. Let's focus on that third step for a minute, because this is where the real magic happens. It's called compound growth. Just look at this example. If you invest $200 every month for 10 years, you've put in $24,000 of your own money. But with an 8% return, that could grow to over $36,000. That extra $12,000, that's your money making more money, all by itself. That is the power of compounding. All right, you are so close to being ready, but just getting started is only half the battle. Now, we need to talk about the mindset that separates successful investors from everyone else. This is how you stay in the game for the long run. So let's talk about the traps to avoid. First, never invest money that you're going to need in the next couple of years. Second, the market will go down sometimes. It's normal. Don't panic and sell everything. Third, try to ignore the hype about the next big stock you see online. And finally, don't even try to time the market. It's a losing game. There's this famous saying in investing, and it is so true. Time in the market is more important than timing the market. Success doesn't come from being a genius who can predict the perfect day to buy or sell. It comes from being patient, staying invested for years, and just letting your money work for you through all the ups and downs. So you might be asking, how do I stay consistent? Well, there's a brilliant and simple strategy called dollar cost averaging. It just means you invest a fixed amount of money on a regular schedule, say $100 on the first of every month, no matter what the market is doing. You just set it and forget it. And here's why that's so powerful. In January, your $100 might buy you 10 shares. But if the market dips in February and the price drops to $5, your same $100 now buys you 20 shares. You automatically buy more when prices are low, when things are on sale. It takes the emotion out of investing and can really boost your returns over time. Okay, we've covered the why, the what, and the how. Now it all comes down to taking that very first step. This last part is all about putting everything into motion and actually starting your journey. If you remember one thing from all of this, let it be this. Start small. You do not need to be rich to start investing. You just need to start. Even a little bit is infinitely more powerful than doing nothing. The second key is to just stay consistent. Building wealth is a marathon, not a sprint. Making those regular automatic contributions, no matter how small they seem, is what builds real momentum and lets that compounding magic happen. And finally, always think long term. Keep your eyes on the horizon. The goal isn't to get rich next week, it's to build lasting financial security for your future. Patience is your superpower. So, I'll leave you with this one final thought. The small, simple decision you make today could have a massive positive impact on your life, 10, 20, or 30 years from now. The question is, what action will you take today that your future self is going to thank you for?